Good evening, everyone. I'm Frank Congilose. I'm the managing partner here at C&A Financial Group. It's my pleasure to be with you this evening, along with Bob Farrell, one of our partners and our investment strategist and manager here at C&A Financial Group. So, Bob, always a pleasure to spend time with you and just sharing thoughts and ideas with our clients and our friends. And so, needless to say, 2022 was an interesting year. And as we went then through last year of 2023, I think for a lot of our clients and friends that have watched what occurred, we never would have thought that, the year would have ended up the way that it did after all was said and done. And a lot of, what took place was in the last, few months of the year.
It was a pretty remarkable run over the last few months into November, December in the market.
And so, it's one of those of here we are now in January of 2024, and it's good. It's making itself up to be kind of another interesting year. We've got an election that's going to happen. We just had the Fed speaking today with regard to interest rates. And, everybody's kind of wondering, how does all that play out? How does everything fit in? And so having said that, maybe just giving a little review as to, what occurred last year and talking about, maybe how it contrasts the prior year and some of our thoughts for our listeners and for, those of us who are online with us tonight. So what are some of the thoughts that you have?
So as you go in and take a look at, the macro environment, I think it'd be good to talk about what happened in 23. I'm going to take a look at how we're going to go into 24 and what the market's looking at 24, and then some of the challenges and how to navigate through some of those challenges that are going on. So as opposed to the returns of the S&P, here's some industry returns going back from last year, and it was a remarkable year. You can see NASDAQ, the Russell, the Dow, even though it's all up double digits and pretty significantly. And it felt really good. And you had this unbelievable run of people can take a look from kind of November. And a lot of that had to do with the Federal Reserve that kind of signaled to the market that they were done raising rates and they're on a path to probably lowering rates into 2024. Which gave the impetus to you take a look at NASDAQ and how it's run like right here toward the end of last year. That's a pretty significant jump. But interesting when you take a turn and say, well, what did the market really do from 2022 to 2023? And in all reality, what it really did is recoup the losses that we incurred in 2022. And I think this graph kind of illustrates it pretty well. And you can kind of see where we're in real rough patches in November and December of 2022, and take a look how it all came back. So what this graphically kind of tells me is a well-balanced portfolio that is constantly ensuring that the asset allocation is proper, is the right way for long-term capital growth. That from an emotional side, I know it wasn't really easy down here. It felt awful. But conversely, if one would have panicked and done something, the right thing to do is reallocate more to that sector if you have a weighting towards it. And that is the best way that I feel for long-term capital.
And it's interesting is, I would say is, when things are going down, it's, typically, people have diversified portfolies. There's a combination of stocks and bonds that are in there. And the philosophy is one, it's like one zigs, the other zags, and yin and yang. And it was interesting in 2022, both the equity markets, and we can go through, I don't care if it was the Dow, the Russell, the S&P or whatever, every single one of them was negative. But if I look at the bond side, it was interesting. All the bonds were down as well. So it was kind of like that double whammy. We didn't have that one down, one up, and just kind of balanced us out.
Yeah, it was the challenge for the 60-40 portfolio, right? Because generally as equities or the stock market tend to outperform, the debt markets underperform. And a lot of it has to do with the level of rates. And we kind of went through a period where we were leaving rates low for a very long period of time. And candidly, it was utopia. The Fed felt that our inflation was transitory, and they used that word. I'm sure everybody's heard that word, and signaled to the market that they had no intent really to raise rates because the inflationary pressures that they had seen, they felt would not stick around and they would go away. Well, they were wrong, and they went on one of the most aggressive campaigns raising rates in modern history, going from 0 to 5.5%. And really impaired not only the stock market, but the debt market. So you had this challenge where you traditionally have that one offsetting the other, just didn't work in 2022.
And so, what's kind of also interesting in all of this is, many times, I know that, we'll have clients and we'll have, friends of ours that'll look at their returns and they'll say, but I saw that, last year the Dow did well, or the NASDAQ did well, or the S&P did well, and yet their portfolio didn't have as much up as necessarily if they might have seen there. And one of the observations, that was brought up to me and that we've observed is that, when you go beyond like the large seven, which is Apple, Microsoft, Alphabet, Amazon, NVIDIA, all of those, they accounted for, a large part of the run up last year.
Yeah, it does. And I think it's really important to get across to people that when you look at the S&P, when you look at not really the Dow, but when you look at the NASDAQ 100, these indices are capital weighted. So there becomes a very heavy concentration because how you reconstitute and rebalance it has more to do with the market cap of that stock. So I have a graph in here and I'll kind of jump to it and it speaks to that. And this surprised, I knew the capital weighting was high. I never realized. So if you had to equally weight the S&P, you would think that there would be at a 500 stocks, every stock would get a weighting of 0.25%. In all reality, 414 of those stocks have a weighting less than that. In NASDAQ, you have 77 have a weighting of 1%. You can kind of see here the heavy concentration in the names that you just mentioned, Frank. So when people look at their portfolio, these indices are capital weighted and market cap weighted. So there's more Apple shares in it. There's more Microsoft. And you can see here, 34% of the S&P 500 is 5 stocks or 6 stocks. It's very significant. And it's also very concentrated in tech. So it speaks to your point where people look at their portfolio and say, well, NASDAQ was up X percent. I was only up X. Conversely, look at 2022.
And it's interesting is, Bob, and I know that you'll show this slide in a little bit. If we look at a diversified portfolio of what the different indexes perform over longer periods of time, things tend to catch up and they tend to flatten out. And, I'm going to let you speak on that. I know you're ready, but, one of the things that caught my attention and that I share with people is, where if we were to look in, let's say the S&P 500 or the Dow or whatever, and we look at what multiple of earnings it trades at, and what that means is that the value of a stock is determined by here's your earnings and what multiple of earnings, how many times earnings are you trading at. And historically we might see 16 or 17 times earnings, things of that nature. But when you see some companies that, the example, here's one on our list, that's Tesla's over 60 times earnings. Or we could look at Apple 29 times earnings, or we look on average at those top 7, and they're almost 35 times earnings. That means that they have to grow and have so much profitability going forward that will they catch up? And so that diversified portfolio in the different asset classes over time, maybe you could speak to that and show share with the what that slide is talking to.
So we went back and said, let's go since the beginning in 2000. So we're going back plus or minus 23 to 24 years. And it's interesting that these are annualized returns. And I was very surprised how close these returns on the major indices are. You have 7%, 714, 736. And ironically, the Dow, which has been the underperformer, is 756. And again, it speaks to a balanced portfolio, and it speaks to reverting to a mean. It speaks to having an allocation to very different sectors. Do I personally think some of these P's are a little frothy? I do, and it's just, but they're technology stocks, and everything that's categorized with technology is going to have a far greater PE because of the potential for profit in technology. I think the outlier there is Tesla. People have been challenged with that. Is it a battery company? Is it a technology company? And it certainly doesn't have a PE like an auto company. But I think one of the challenges of the market's going forward because there are some frothy PEs.
And so having said that, here we are at this new year, and January seems like was a little iffy starting off and so forth. And I didn't quite catch. I think that it was a little bit of a sell-off here on the 31st of January.
The market was challenged a little bit today, yes.
And here we are now, also an election year and everything else going on. And one of the things you and I spoke about a little bit earlier today was the fact that the Fed met today and they were talking about interest rates, and a lot of people understand at this point that, the Fed is probably done raising rates. However, when they start reducing rates is really the big question, and how much. And it's that anticipation which is motivating people to buy stocks or to buy bonds or to sell something. And so what are some of the takeaways that you're having on that, or that you've heard from the Fed and so forth, that people can kind of keep in mind?
Yeah, so I think what we should talk about, so people understand, is why the Fed uses interest rates. The idea of why does that control the economy? And our Federal Reserve has a dual mandate, and it's labor and inflation. And to simply put it, it would be they want to ensure that everybody who wants the job can get a job. And the second part of it is the purchasing power of the money they're made doesn't skyrocket out of control. So that's the dual mandate. And how they measure that is the unemployment rate and the consumer price index. And they're probably two of the larger. And they've always, and will not change, they want to see a year-on-year 2% number for CPI. Conversely, they want to see a labor market that is robust. And it doesn't get to the point where there's not enough people in the labor market where it creates wage inflation that passes that along. So they monitor the unemployment rate and CPI. That will ultimately determine the path of interest rates. Now, why they use interest rates is that they feel that traditionally inflation is caused because people have access to cheap capital. And with the access to the cheap capital, they jump in front of each other for goods and services. So if you could temper that a little bit by charging banks more, the Federal Reserve charges banks more for money, they will pass that along to the consumer. And hopefully that'll slow down the spending and slow down the growth. That is the general idea as to why they use interest rates. And it'll get to the point that they want to slow the economy down. And the speed break is the funds rate, which is the rate that they charge banks for overnight lending. And you can see on this graph that you went through, this is going back to 2004, the funds rate was at 0, it's now 5.33. That escalated climb, it's often that rates come down quickly because it tends to be a geopolitical event or something like that. COVID is an example, and you can kind of go through the housing crisis right here, COVID right here. Rates often go down very quickly. Very rarely do rates go like that. And it was during this period right here where the Fed felt that this inflation was transitory. Obviously, it didn't pan out that way. So why rates went up is this is CPI. And we're going to go back, and the Fed really likes to keep this right plus or minus 2%. Look at what happened here and the disruption that we saw in 2022.
Yeah, I remember paying $4, almost $5 a gallon for gas.
Yeah, exactly. It was energy prices. It was labor shortage. It was supply shortage. It was people paying over sticker for a car.
Exactly.
And the weight on that. So the Fed didn't like that. And that spike created why they had to raise rates where they need to do. And this is something that is the job opening JOLT report, what the Fed looks at, and it looks at people in the labor force. And so you can see here, there was a heck of a lot need for more jobs than there were. And now you see from a trajectory side where we're heading. And this is kind of a job opening, job loss report that the Fed looks at. So what does that lead us to? So the Federal Reserve met today. And this is the unemployment rate. Again, you can see where the spike is and where it is. They made it very clear that they have no intention to raise rates. They also made it very clear that they want to see our consumer inflation get to 2% or start heading toward that. And they don't want to see labor pressure. And they made it very, very clear in the market today. The market is pricing in a lot more of a Fed give back. As of last year, let me go to this slide because I think it speaks to it. This was of the end of last year. And these are quarter basis point moves. So you could see that at the end of last year, in the end of it, there were over 6 easings priced into the market, priced in already.
Which is a lot.
Which is a
That's
lot.
A 0.25%. Each time that means that it would have dropped 1.5%.
That's exactly right. And I think the market today, the Federal Reserve comes out with their decision, and then there is a Q&A session where Chairman Powell takes questions from the audience and generally reporters. And sometimes it's very what we call dovish, meaning he's really going to ease a lot more. And sometimes it's a hawkish report, which is, wow, the market's pricing in too much. I would say in this meeting, he made it clear that he's going to, the next move is probably going to be lower, but when that's going to be, I just happen to think the market's pricing in. They always price in more, but I was a little surprised that there were 6 tightenings or cuts priced in this year.
And so, a couple of interesting things, because I think when, our audience and, our clients and our friends listen to this, some of the things I'm sure that are going through their head is, so what exactly does that mean in terms of where are we and what, should I be doing today? And you and I talk a lot about this, which is, I think it's one of the first times that people are seeing opportunities where you can actually put money in bonds. And instead of buying bonds to provide a little more stability in a portfolio, you can actually buy bonds to get a nice return, where, they're not paying 1% to 2% anymore. You've got 4s and 5s and 6s that are being paid. And so it's a little different environment. And I know that's one of your areas of specialty. How are you feeling about bonds and fixed income and some of the opportunities now? And seeing how you spent a lot of your career always talking about bonds, a little different today than it might have been 2 or 3 years ago.
Well, you had periods right after COVID when rates were ridiculously low. The U.S. government was issuing, there are treasury bonds, 30-year treasury bonds out there that are 1 5/8. 1 5/8. I think the environment right now is exciting for the bond market. I think people, I think an audience of people were almost forced into an asset class for a return. And I didn't think that was very healthy. That if you can't get anything out of a CD, whatever it may be, they were forced into something that would generate a return. I think this has allowed people to pull back a little bit and allocate to a safer asset class and get compensated for it. And
so in other words, only because I know how smart you are and how technical you are. And so when I kind of listen to that, I think that what I'm hearing is, where we had to take on more and more and more and more and more risk in pursuit of a return because interest rates were so low. Okay. That all of a sudden there was a reset button that's now been pushed. And all of a sudden now we can have bonds and investments that have good quality,
right,
and so forth, that have nice returns.
You're able to get that, 5% return. I think one of the biggest challenges in the market right now is we have an inverted yield curve, and we've had it.
And so when you speak to inverted yield curve, in case some of our listeners aren't sure, maybe share what that might look like.
Sure. So traditionally, you should get compensated for longer term risk. So if I invest for 2 years versus 5 years, you would think that should get compensated at a higher yield for 5 years than 2 years, and a higher yield for 10 years than for 5 years. Given the easings that are priced into the market, very short-term rates yield higher than long-term rates. And we've seen this mass push of money getting put into T-bills in short-term because T-bills at 5%, this is great. I don't view that as an allocation toward fixed income. And the challenge is, it's all well and good that you can invest for 1 year at 5%. But if you're an investor, there's no guarantee you're going to get that 5% a year from now.
So what you're saying is my risk is in my reinvestment risk when that money comes due, of what the environment might look like when that happens. And it was interesting as I was reading a report recently issued by BlackRock, and they were just saying that, when rates actually start going down and they actually do reduce, how quickly short-term rates go down so fast.
Yeah.
And they move very quickly.
Yeah. And they will move very, very quickly. And the Fed tends to announce this, but it is a radical move when they do it. So when it comes to investing, I'm an advocate of, if you need to warehouse liquidity temporarily, it's great to put money in a bill.
Sure.
And I'm an advocate of that. But when it comes to allocating out the yield curve, I think it's really important to be able to go out further and to be guaranteed a return for a period of time. And I think
there's a benefit also to that, if I was holding a bond at say 5 or 6% and rates go down, the value of that bond, just like, when rates went up so quickly and my bonds were worth less, those bonds actually will have some embedded gains.
No question.
Unless I'm holding to maturity, which is what I should do.
No question, right? And I think most of our clients are not traders, they're investors.
Correct.
And I think the important thing, and I tell people all the time, that if you invest in a stock at $100, I can't look you in the eye and say 10 years from now, that stock could be $100. It could be 50, it could be 200. And if you put $100,000 in a bond that pays 5%, short of a default of the issuer, and we don't traffic in that world, you're going to get your $100,000 back and a continuous stream of income of 5%. And I think that is the biggest difference between a bond versus a stock.
A great insight. So just for our listeners and summarizing, what that might sound like to them, which is where, historically somebody might have a 60-40 portfolio or a 50-50 or whatever, and that bond allocation previously was put in there to provide an added level of stability. Now when those bonds are in those portfolios, not only are they providing that added level of stability, but they're also earning a nice yield that we haven't seen in a long time. So it actually helps to provide a better return in the overall portfolio long term.
It absolutely complements the portfolio.
So
and we're finding more and more of our investors talking about a bond market that they haven't talked about for 3 or 4 years because of the opportunities that are afforded.
Now, having said that, I wouldn't go and shift 100% to bonds because, just being in this as long as I have, which is I had hair when I started in this, and that was a long time ago. What we've also identified over time and what we recognize is that when interest rates are coming down, usually equities are also a very nice place to be in because companies, that are borrowing money to run and everything else, and even the consumer, they tend to pay less in interest. They have more money to spend, and there's more money going in the economy. So lowering rates or rates going down over time are generally pretty good.
Yeah, I would think you're definitely right with that. I think for bond investors, your biggest risk for a long-term bond is the purchasing power of your income stream. That if you're getting 5% today, and you're taking a coupon of a $100,000 bond of $5,000 a year, and you need that, what is the purchasing power of that 5,000 10 years from now? And that's why it's very important for the Fed to control these rates, because that's your biggest risk with longer term bonds, that the income stream associated with it doesn't buy you what you think it could buy you. And that's why the Fed is very focused on ensuring that our inflation rate is at 2% to control that.
It's great insight. And so, having said that, that makes the case for that balanced, diversified portfolio. It also makes the case a little bit, and I'll address this, is one of the things I've also heard and that I've seen, from many of the companies that we deal with that are, large money management firms, all name brand companies that are out there, is that not only do we suggest diversification, but there are also opportunities outside of the U.S., which is, having some global exposure and so forth. I'm not saying a lot, but some, because other economies have not recovered the way that we have.
Okay.
And so some of those are trading at lower multiples. There's more value sometimes elsewhere. And so that diversified portfolio makes sense. And maybe Bob, just speak to that for a moment.
Yeah, I'm a big advocate to have an allocation toward international in a portfolio. I'm an advocate to have a nominal amount in emerging markets. I just think it makes sense because any given day, some of these weaker economies can turn around. You can look at a place, India, and the growth of India and what's going to eventually happen there. And you take look at the growth of China versus India. They're crossing, right? Mm-hmm. India is going to become, so you take a look at some of these international, whether it's a mutual fund or an ETF that participates in some of these countries. I think it's very important to have an allocation toward that. That said, I'm in the camp that if you allocate toward that economy, you live and spend in dollars if you're in the United States. And one of the risks that you have when you invest internationally is you could have their equity market being up 10%, but if their currency depreciates 10%, you've made nothing. And there are different funds that are out there that will currency hedge it for you. And one of the stark differences last year was you had an outperformance in some of the foreign stock market, like our stock markets were up, but their currency depreciated. And by doing that, they made nothing. So that's something to really be focused on when you invest internationally.
Great insight. And so, I want to ask you who you think is going to win the Super Bowl.
Okay.
Because I think that doing what we're doing is a little bit easier to watch. So we won't go there. And I won't ask, what do you think of the election? So we're not going to go there.
Thanks.
But we do have people that look and they go, with all the craziness going on in the world and everything else, is it still a good time to invest? And, having said that, is we don't have a crystal ball. However, as interesting as I was fortunate that I have this, and I'll share with you, something that, was BlackRock sent out, and they were just talking about the S&P 500, and they're going back and they're saying, if we look from, 19, over the years, and I think it was 1970 that they did this to 1923 at all the different elections that came up, what occurred on average of the S&P 500. So in the first quarter of the year, an election year, was up 1.3 on average. In the second quarter, 1.5 on average. In the third quarter, which is, boy, the election's coming up, the markets better look good.
Yeah.
They were up 6.2, and then we look at the fourth quarter,
It dropped.
and no, it was 3.3. So it looks like oftentimes where people get nervous and they're like, oh my gosh, all the things that might go on, get me out of this before the election. And yet maybe the idea is, you know what, we can't time the markets. Things like this are going to happen. And if I actually look at historically what's occurred, this year typically looked pretty good on average.
Yeah, I think it speaks right time. And our clients are investors.
It's time in, not time in.
And an investor's mentality is far different than a trading mentality. And I kind of liken it to, if your house is worth more on Zillow, are you going to buy more house if it's lower? Or are you going to sell your house if it's higher? Because you live in your house. It's an investment. And I very much look at asset and portfolio and growth very much like that you are entrusting people like us to invest your money. Yes, having traded at hedge funds, that's a very, very different skill set. For some of our larger clients, an allocation to that alternative strategy, and a very modest allocation that we can do, yeah, it makes some sense as to give them different alpha. But for what we do for almost every one of our clients, they want an investment philosophy, not a trader's philosophy. And will the election? Sure, it's going to impact. And I was fortunate to attend a meeting last week, and it kind of went, they had a couple of strategists there, and their idea of what could happen, and more importantly, based on the election, what could happen with tax rates. And I will tell you, there's varying opinions out there. There's varying opinions as to what's going to happen. But it's going to be a challenge to navigate. But I look at it as you still make sound fundamental decisions for your client base and invest accordingly, knowing that the election is going to be there. There's a midterm election, there's an election all the time. And I think the challenge is that people often make lifetime decisions based on administrations. And
agreed. And the reality is 9 times out of 10, it's wrong.
Yeah.
And when I say that is, if we look, it's time in, not time in. And having a philosophy around investments, having a risk profile that you can live with, that you know what you own, you know why you own it, you know how it was put together with advisors like ours and ourselves, I think is really what we're speaking to. And then it's a matter of, when things go up, our job is easy. When things go down is really when, I always say is our clients and our community needs to lean on us. And I always say we're like the firemen, or I always call myself the chubby kid holding on to the back of the rope, saying is we're going to hold the ground and allow it to recover. And the reality is, the longer that we're doing this, I'm 40 some odd years, you're similar. Yeah. There's always an event going on. 9/11. There's a war. There's always something. And what happens is we get a spike one way or another, and then it always returns to the means over time.
No question. And we've all felt awful. I mean, there's nothing worse than waking up during the mortgage crisis. I was on that day, I was trading at 9/11 in New York City, right? We all experience, and felt like the world was going to end, but somehow we recover. And I think that's a testament to the United States. It's a testament to our economy. We've found a way to make it back. And sure, you're going to have periods where it's really, really tough. And you're going to have periods where places go bankrupt.
Yeah.
That's part of it.
And by the way, that's capitalism.
Absolutely.
And that's a part of reason why is, investing in globally diversified portfolios, between equities and bonds, by doing that is, and not picking one stock, because I could have picked one stock and there's some that it's like, oh my gosh, could have been a fortune. At the same point, I could have picked one stock and been broke. It's like we don't know what that one stock's going to be, but at the same point is if we diversified, we've got a great basket of stocks for the long run or even bonds. We should be in pretty good shape.
So you go back to one of the slides that I had up prior that kind of showed everything plus or minus 7%, but it wasn't 7% a year.
No, it's not that flat.
Right.
Our job would be easy then. Actually, they wouldn't need us then.
Yeah, right. But I think that had years where you're down 50%, that had years you're up 40%, right? And it's time tested and you feel awful when it happens. But if you were to make a lot of bad decisions during that time frame, you wouldn't be up 7%.
It's a great
insight. And you need somebody like, the team that we have here to navigate through that. And it's really important.
And so I'll just end on this, which is over the years for our clients, our community, and our friends that are getting close to retirement, over the years, when interest rates were very low, we used to hear about the 3% rule or the 4% rule. And one of the interesting things about that is the idea behind that rule is that you had to have a total return in order to get it because interest rates were so low. Nowadays, you can have a more intentional, more meaningful investment strategy and philosophy where you can have holdings that generate that kind of cash flow and income so that it's not just the total return. Hopefully we get some growth, but we can get enough cash flow to meet somebody's needs out of the portfolio, which we haven't seen that in a long time.
So you think about what, again, the 24-year average is 7%. And that is at risk. A municipal bond today could be 4.5%. And in most people's tax brackets, that's like 6.5 to 7%. And think about the risk associated with that versus the risk associated with the equity market. Now, you have a need to hedge inflation. You need to be in the equity market. But it speaks to how you've come up. And now you can make a genuine comparison between both rather than one looking at it like, there's no way I'm putting my money there.
Great insight. So, Bob, before we wrap up with our friends tonight, any other perspectives, anything you want to share between now and the next quarter?
Well, I think now in the next quarter, I think that we're going to be looking toward the Federal Reserve is the market and how much the market is driven for interest rates. And today, unfortunately, the market suffered a little bit. I don't think for interest rates, I don't know. A couple of New York Community Bank today cut its dividend. Very large regional bank. They were down 40% today. One bank, and a lot of regional banks got hit. I do think that having to do with inflation, regional banks tend not to be as sophisticated as some of the large developed banks. And to a degree, I think they've gotten their house in order, but some of the issues that were there with Silicon Valley and these banks with low rate loans on their portfolio, they're not going away. And the only thing that solves that is lower rates. And it was I think people kind of forgot about it a little bit. We had this regional bank crisis and all of a sudden it went away. And today it didn't go away. It didn't go away. The Fed changed a couple of rules with pledging collateral that allowed them to give U.S. government securities, even though it might be worth 70 cents on the dollar. They took it at 100 cents on the dollar to give them money. So they instituted a couple of programs to kind of get them through it. I do think there might be still some challenges there when it comes to rates. I think the Fed has acknowledged that. I do think we're on solid footing, though. I really do. You take a look at, I think our debt situation in the United States is problematic. And I have two graphs up here, our debt to GDP at 130. And then you take a look, not only that, as a percentage of cost of servicing our debt. That number's starting to get really high. And
my philosophy on that has always been it's a motivation for the government to keep interest rates low so that they don't have to make that large of a payment, which they're not paying, which they're financing.
Right. So
they get into debt slower.
That's exactly right. And I think we're going to continue to issue an awful lot of debt. And you think about when the Central Budget Office was calculating what our debt to GDP would be when we're financing U.S. Treasury bills at zero. and now they're at 5%, and the impact that has on the budget. And I think the challenge of that is where you stand politically. We have a spending problem, and we need more income, because I don't think the spending problem is ever going to be fixed. So you got to think about low-hanging fruit, what's out there that could accelerate income to the government. And we're always thinking about that. There has been talk about inherited IRAs and accelerating that. Some of the ideas that we talked about last week is depending on the administration, capital gains getting adjusted. And what does that look like? Corporate tax rates. So all of these things like that we're thinking about as to how it can impact the portfolio.
Very good. It's a great insight. So for all of our listeners, and those of you visiting with us this evening, you're catching us live. Again, there's no certainty in investments. They're going to fluctuate. But we do know for the long term, when we think about it, is, historically they've done well. It's the right place to have, your money, which is a well-diversified quality portfolio. And, things are going to happen. You're going to hear about, whether it's the Ukraine or it's Israel or it's Iran, and there's an election, and there's always something going on. And when we look at that, and I would look at the charts over 10 and 20 and 30 years, even when there's volatility, it's a blip and then it's gone and we're back on track.
Yeah, I tell people the high comes every 3 years.
It's a great insight. So Bob, thank you for
Absolutely.
the insights tonight. And for all of you that are listening, again, Bob Farrell, Frank Congilose. We look forward to seeing you next quarter. Have a great evening.